Right, what's up? We're here again with Evan Beach from Equity Prime. We're just going to do a rundown. We've been doing this semi-weekly or semi-regularly, just a breakdown of what's happening in the mortgage world and how that affects real estate. Evan, if you can take us away on the MBS update.
Certainly. How's everybody doing? Hopefully everybody's staying as safe and as sane as possible in these very bizarre and weird times. Obviously, everybody's going through the same thing here. Yeah, I just wanted to jump in and I'll share my screen here so we can get into where kind of the market's at and take it from there. You see that, Gil? We good?
Yep.
Okay. So as we touched on the last week and the last few weeks here since we've been updating this, again, briefly, mortgage-backed securities are the kind of the lifeblood of how mortgage rates work, if you will. So higher mortgage-backed securities, the higher this is, typically, and I say typically, I'll dive into that in a minute, but typically that means interest rates are going to be lower. So again, we went over this chart last week and 2 weeks prior, but this is the recent MBS chart up until this minute. So again, just very brief, end of last year, all these little minor candlesticks, green is good, red is bad, minor little fluctuations as we go through here. To put this into context again, where these levels were basically rates that were 4%, 4 1/8, somewhere in there, the 30-year fixed with the proper credit, et cetera. As we went on through the beginning of this year, obviously as this goes up, MBS goes up, rates go down. So you view it as a stock. The stock gets more expensive, rates are going to go lower. Excuse me. So as you can see here, we saw a little bit more fluctuations here. This is roughly what's called 30 basis points, which isn't even really an eighth in rate. And as we get into this further, you'll see this is when rates really kind of bottomed out, almost all-time lows, really Monday morning, March 9th. And you'll see this, they call it alert to lock because rates were at all-time lows. So obviously you should have been locking. But what this translated to was roughly, in the right circumstance, 3% flat on 30-year fixed, which is phenomenal. However, then what happened was this was right about the time the coronavirus fears really got kicked into high gear and the markets just went out of control. Stock market tumbled. Like we said, the last or 2 meetings ago, I guess, right, Gil, we had the stock market that tumbled 2,500 points in the day. So this is when this was happening. So you'll see going back to the end of last year, all through this is normal activity. And again, I'll show this just for demonstration purposes. The 2-year, you'll see this is normal activity. This is not normal. So again, to pull back into this quarter, I mean, this is madness, obviously. And again, I'm not going to beat a dead horse. We went through this last two presentations that we've done. But this meant that rates skyrocketed about 1.25 points in a matter of 2.5 days. Boomerang back down, went way down again, bottoming out. This meant they were in the mid 4s, high 4s again. Then they went back. I mean, we were just all over the map in the last 2.5 weeks here. So now what's happened is, as great as this looks, the problem now has become is that, again, we'll see here, we got up to easily all-time highs in mortgage-backed securities at the end of last week. I mean, we were at 105 on mortgage-backed securities, which is unheard of. Look at all these other levels. I mean, again, just to show you where we're at here, look at this pulled back 2 years and look where this was. I mean, it's astonishing. So normally that should have translated to easily, by far, all-time low interest rates, which what I mean by this is if the MBS is at 105, that should have translated to 30-year fixed mortgages in the high 2s easily. I mean, we're talking maybe even mid 2s. So 2.625, 2.75 would have easily been attainable if mortgage-backed securities, if this was a month ago, prior to all this madness and volatility in the market. And what I mean by this is that now we're seeing MBS that it doesn't have a direct correlation, as crazy it is, to interest rates anymore. So the 10-year Treasury and mortgage-backed securities that we'll see here, we follow these like a hawk. Again, this is a website, MBS Highway, that's phenomenal. It's very, very nerdy unless you're in our industry. So I don't expect everybody to understand what all this means. But normally, the lower the 10-year Treasury, and I say normally, a month ago, normally, with 10-year Treasury, as it goes down, rates follow suit. As this goes up, rates typically dip as well. So these things are normally intertwined. Now, neither one of them necessarily makes much sense to rates. So the reasoning for that is, and I'll bring in this article, and again, I'm not going to read this verbatim, but what this is saying is basically that the big problem where we're at is with the service. So, and again, not to completely go through everything that that this states, but it talks about how the mortgage process works. We're mortgage originators. We start we hit the gun and people start borrowing money. We originate mortgage loans. Then there's a handful of servicers throughout the country who typically take over the servicing rights to the mortgage, and you make the payments to the servicers. So servicing mortgages is vastly different than originating them. Servicing, you are simply collecting payments and making sure the payments are applied correctly, making sure people are paying things on time, so on and so forth. Problem is, and again, I mentioned the servicer dilemma. When you have such a deluge of business like we had a month and a half ago with a refi boom, and then you throw on top of it a completely unprecedented market with what happened with coronavirus, servicers got absolutely hammered. And servicers basically said, we don't want to accept any more mortgages. We're not going to service anything else right now. So what they did was basically they said, okay, we don't want to service anything anymore. So we're going to price out and calm the market down by not offering what's called SRP, a service retail premium. So look at it this way. You're basically wiping out a huge portion of how a mortgage lender like myself and my company and other mortgage lenders that are mortgage banks, how we would make a profit in the transaction has now been, a portion of that has been wiped out. So rates obviously aren't able to go down because of that happening. So the big problem now, and what everybody is now focusing on in the mortgage world, is how's the government going to bail out the servicers in the country? So there's roughly 7-8 servicers make up about 70 to 80% of the servicing in the country. So there's a very small amount of servicers that make up a very vast amount of mortgage, of collecting the mortgage payments. So until they get stabilized, we're not going to see rates dip to where they were 3 weeks ago. So what that means is, again, there were some great locking opportunities towards the end of last week, and I locked a handful of loans because it made sense. But now we're seeing rates, even though these went up, we're seeing rates go up as well with this, because of there's not that premium in there anymore. And so until the service market gets sorted out, it's going to be a weird time for the next week or 2 weeks until this gets settled. Also, the reasoning for this and the reason why these prices went so far up is the Fed stepped in and said, we're going to start buying a ton of mortgage-backed securities. And when I say a ton, I mean a ton. They were spending a minimum of $20 billion a day on mortgage-backed securities. So when the government steps in and does that, the premium of these goes way up. That's why you saw it topping out here. But again, to reiterate, to simplify this basically means that rates aren't as great as they should be. And to touch on something that Gil wanted me to hit on, the Fed rate being at zero has zero correlation with 30-year fixed mortgage rates or mortgage rates in general. I got I was flying down to Florida in the 2-hour flight. Didn't have my phone on, and that's when Fed decided to drop their rate to 0. I opened my phone. I had 27 text messages from clients saying, "Hey, I want to refi now. Rates are at 0. What are we going to do? Oh, can I get a 1% mortgage?" And so on and so forth. So I had to regurgitate the same conversation over and over that has zero correlation. In fact, that was in this time frame where we actually saw rates jumping up at the same time frame. That was the weirdest week ever in mortgages. So again, just to reiterate that. So the other point you really got to hammer home, and I'm sure Gil agrees with me, is now more than ever, the shopping for mortgages is next to impossible right now. There's certain companies that have simply stopped originating mortgages. They're not taking applications. That's the first problem. Second problem is, as you can see from these charts here, things are changing on an hourly basis. If the government steps in and bails out the servicers, we could see rates drop 3/4 of a point literally in a day again. So if that happens, we're in a completely different marketplace than we are right now. So you really have to trust your loan professional. Hopefully it's me, but you really have to trust your loan professional when he's giving you advice and saying, "Hey, it makes sense to lock now. Here's why." Take that advice and run with it, because I'm seeing people that that feel like they're in Atlantic City playing blackjack, and they want to say, "Oh yeah, let's gamble. Let's see if we can get back to where we were 3 weeks ago." And now here we are, where rates climb up again, and we haven't had quite that dip back down this week yet. So
when you say
again, very important.
When you say if the federal government bails out the servicers, that's because right now they're all frozen up because they're still liable to pass along. They've got to actually pay the payment to the investing, like the pension funds that have bought those mortgage-backed securities, correct?
Yeah, and I'll dive in a little bit more to what I mean. That leads me to my forbearance issue. Basically, the servicers are scared to death to take on any more business right now, and rightfully so. Look what's happening with what the government is feeding over and over in the news. I mean, they have the stimulus package that they're saying everybody's going to get a certain amount if you make less than X amount. Also, what they've done here is I get, again, 27 phone calls a day on this too. Now this just recently came out where they're calling it the COVID-19 residential mortgage relief, which, again, I mentioned this to Gil earlier. It's an awful way to word this, and I'll explain why. But to hit back on the servicers, they're scared to death of servicing a mortgage right now, because if they buy the servicing rights from a lender like myself, now, okay, they're going to buy the servicing rights. Well, wait a second. Now they're going to do mortgage relief. The government's saying mortgage relief for up to 90-day grace period on mortgages. Would you want to be a servicer and buy the servicing rights knowing that you're not going to get a payment for maybe 3 months? But I sure as hell wouldn't.
Right, and
that's the problem
with 3 years or something, right?
I'm sorry?
Isn't the break-even point for a servicer like 3 years, somewhere around there?
It's a little less than that because there's higher turnover in the business, especially when rates have been low. I mean, it's rare that people would stay in mortgages 3 years, but it is a little bit less than that. Depends on each and every situation is different. But really what this is stating is, and again, just to hit home what this all means, and the key portion of this that, I can't highlight enough is the word forbearance. So people need to understand what forbearance means. And they word this as mortgage relief. So whoever wrote this should have basically talked to a mortgage professional before they worded this, because this makes this seem like if I'm the average consumer reading this and I'm seeing, okay, I would look right to this highlighted portion in bold print, 90-day grace period for all mortgage payments. If I'm average Joe consumer, my eyes light up. Holy shit, I don't have to make a mortgage payment for 3 months. This is incredible. This is awesome. Maybe something good is going to come out of this. Not the case. forbearance. And again, just to kind of dumb this down, I've even pulled up the definition of it. You can Google this and it pops up. What does loan forbearance mean? Your loan payments are postponed, but big but, interest continues to accrue during the period of forbearance. Very, very, very important. So what this means is if somebody goes into this forbearance plan and says, all right, I'm not going to pay my mortgage for a month or 2 months or a 90-day quote unquote grace period, there is still interest accruing for this. They are not giving you a pass on mortgage payments. They are simply delaying the mortgage interest or delaying the payment. And what's going to happen after that period, whether it's you don't pay one mortgage payment, 2, 3, whatever that time frame is, whoever's holding that mortgage note, if you're the mortgage person holding the note, wouldn't you want your money at some point? So that's what they're going to do. They're either going to say, all right, they're going to turn around and they're going to immediately jack the payment and start getting that back interest immediately, or they're going to tack it onto the loan. I mean, we don't know what exactly this is going to look like yet. So it's a scary thing to put this out to the average consumer because they automatically think, and I can't blame them, I would feel the same way, that, okay, cool, I don't have to make a mortgage payment for 3 months. So we can't state this enough. If you have the ability to make your mortgage payment, make your mortgage payment. Not even to get into, too deeply as far as what this could mean potentially to people's credit. Again, they're saying that the forbearance program will be deemed a hardship and it won't affect your credit. Guess what? If I could tell you the amount of things that people were told won't affect their credit and does, if I had a nickel every time, I'd be a very, very rich man. Again, it says here, no credit score changes. I can guarantee you if this truly, if people are going to start doing this, I shouldn't say if, we're going to see at the end of this year, we're going to see people having credit issues with this because there's no way there's going to be things that fall through this net as far as it hitting people's credit. It's not going to be a giant foolproof net that just says, okay, this person is in this forbearance program where it's not going to hit their credit. Without fail, it's going to happen. So what people are doing now is they're calling their mortgage servicers, and good luck getting through. Number one, they're going to be on hold for hours. And then once they get through, they're going to say, okay, yeah, we can put you in forbearance. But again, it all depends on each and every servicer is going to be different. So I can't stress that enough. People need to, if you have the ability to make your payment, and you're going to be in a much better situation whenever this blows over. This is meant for, again, I totally understand and I'm sympathetic to the fact that there are going to be people that truly don't have the ability to make their mortgage payment, and that's who this is directed to. The problem is I shouldn't say everybody, but a large portion of the population is going to try to take advantage of this when they simply don't need to. So, much like the stimulus package, there's going to be people that will get that money that don't really need it, that are still working, So again, this is a scary document to see from a mortgage perspective, because I know we're going to be dealing with this come the end of this year when things start hitting credit and late starts showing up or forbearance starts showing up and people's credit starts getting pulled down. I know we're going to deal with it. It's an absolute given. So again, just wanted to really hit that. And, if anybody has a question specifically, please reach out and I can walk you through this in a little bit more detail. But again, forbearance does not mean they're forgiving mortgage payments. So
right.
if you have the ability, please make your mortgage payment.
They're not forgiving. It's not three free months. It's just going to be rolled into it. So you don't know how that would come to. You mentioned a couple scenarios where like the lender or the servicer might start trying to get that interest rate away. Like the interest would accrue. What do you think is more likely, that it would just get tacked onto the back of the loan, or that they would change? Can they even change the payment, or would they just tack it onto the end?
Well, they can absolutely change the payment. So I don't know, to be honest with you. We don't know how that's going to shake out because of the fact that they haven't come through. Keep in mind, if they do that, that just means even more government relief. That means
more
it's
hardship or
basically,
whatever.
yeah, it's basically a stimulus package directed towards your mortgage payment. That's how you have to look at it. So how they're going to handle it, I don't know. But again, they're going to have to have some type of bailout, or else this is going to crush the servicers even more. So if they're going to come out and issue documents like this, they have to be very careful how they're wording them and what people can expect from this. Because this is just, again, just to read this from a mortgage perspective, it makes me cringe. Because I know it just automatically is going to, give people free reign to just say, oh, I didn't pay my mortgage because I was in forbearance because of the virus. Like it's
Irresponsible to
again,
take advantage of it. Yeah.
yeah, absolutely. So again, just wanted to really hit on that. I think it's very important in this marketplace. But again, this is a fluid situation. It's constantly changing. So as we get updates, again, I know we're doing these at least once a week at this point. So if anything changes dramatically, we can certainly jump back on one of these and do it.
Right. Whereas obviously the forecast is no forecast or like that. It's we've been talking about this, like, where do you see it going? And there's not really anywhere to tell, but like, what is the kind of words of wisdom to people that are either thinking about making a move or in the process of trying to buy? Like, how do you make sense of all this stuff? Like, if you own property, obviously keep paying your mortgage. That's one super key takeaway.
Yeah.
Keep an eye out for a servicer bailout. Like, what would the headline be if there was a service bailout that would like start to free up the pipelines that we talked about?
Well, I think, and everybody in the industry seems to feel the same way, that they're going to have to step in and bail out the servicing market or industry, or else it's going to get very, very ugly, because number one, they don't want to take on any more servicing rights.
Right.
And the servicing that they do have, again, like that forbearance document I just showed, that's very scary for a servicer to read, without any type of insurance from the government, Fed, whoever, that they're going to be made whole from that type of situation.
Right. Who are the servicers? Like, there's 7 of them or whatever. What's like would I recognize those names? Are they like BlackRocks or something like that? Or?
I mean, you can see even in this document, they'll, I'll reshare this. Larger groups here that actually service, Citigroup, JP Morgan, Wells, Bank of America, other larger servicers, or, PennyMac.
Well, I'm looking at this
Companies like that.
from the state again, that the same mortgage relief program. Are we looking at the same thing?
Yep. Yeah. So you'll see it even highlights.
Oh, okay.
Some of the, yep. So it even highlights some of that right there.
Okay, so it's like these mega banks.
Yep, mega banks are going to get nailed from this, and servicers, just servicers, PennyMac, Mr. Cooper's another one. There's a handful of them that handle a ton of servicing. So yeah, until that changes, that's got to be the next domino to fall. It really needs to happen to stabilize the mortgage industry. That's the biggest thing. Excuse me. And that article that, obviously that I sent to you and you read and understood, and anybody that wants to read that personally, we can send that to them. Or again, if anybody wants to contact me and go through it, I can walk them through it. But that goes into a little bit more detail of the problem with the servicing, not so much, it's not necessarily originating, we're still very busy. We have people still getting under contract to purchase properties. I have 2 purchases closing today. One that closed an hour ago. Refis, I have 6 refis closing this week. So there's still, business is still churning and moving. I mean, I'm as busy as I've ever been. Now, I'm not naive in the way that obviously this is going to be something that we don't really feel the ramifications from for 60 days down the road.
Right.
We've had this conversation before where, the real pain from this, and when I say pain, I mean strictly in a financial economic sense, is going to be 2 months down the road. When people truly can't pay bills anymore, if we're already going to be in this holding pattern for at least another month. So, and we've been in it for however long, depending upon the state you live in, for 3 weeks.
Right.
So to say that 2 months of a complete stop of economy, for the most part, isn't going to be felt further down the line is, again, a naive standpoint. But like you hit the nail on the head, man. I mean, it was kind of my go-to saying, and I should have trademarked it. Was it's business as usual as usual can be.
Right.
So again, there is and another one that I love is like the new normal is that there is no normal anymore. I mean, any walk of life, be it our business, our industry, or again, that MBS highway, I'll send you the video on that. It's very good insight, is that it doesn't matter what, any business is now going to be changed forever. I mean, think about are you going to go, or anybody that loves cruises, are you going to go get on a cruise ship this year? Absolutely not. That industry is going to get completely crushed. But something as simple as just restaurants. I mean, restaurants are now going to be, let's just say everything's perfect in April 30th, grand reopening of everything. Restaurants are now going to most likely be in a position where they're going to have to spread their tables apart. You're not going to be on top of people. The communal eating places aren't going to be there, which means, again, the trickle down is that's less staff, less profit for the restaurant, so on and so forth. And again, that's a little microcosm look at it, but I think it's the world we're going to be living in whenever this blows over, whether it's a month from now or 2 months from now, and hopefully it's the former. But
right.
yeah, I mean, I think that's just as far as to backtrack to your original question, in our world, in the real estate world, to me, if somebody's out looking at properties, and again, I know they can't quote unquote look right now, or not supposed to be looking right now, right? Not supposed to be doing.
They just put out, the governor just put out a thing to agents can show property basically on a one-on-one basis, but open houses are still on lockdown. So they're trying to, the real estate commission, or the I think the National Association of Realtors, one of the boards, is the regulation bodies, lobbied and kind of reached out. At one point, it was a little bit of a gray area. Hey, is this essential, non-essential? Where does this fall? When Murphy first came out a week ago, I guess, last Saturday or whatever. And then
right,
when whoever runs the show, sent a letter hey, can you clarify this, please, so we can provide guidance to every agent in the state. And I think right now the rule of thumb is one-on-one showings are okay, as long as social distancing norms are there or whatever, but open houses are still on ice.
Yeah. So, I mean, as from my standpoint, I mean, I think somebody going out and purchasing a property, I think it totally depends on what the goal of that property is. And when I say goal, I mean, what's your plan? What's your plan for potentially purchasing that property? Is it somewhere you're going to be as a starter home? Are you going to be there for 2 to 3 years? Are you going to outgrow it? Are you going to have kids and outgrow it? Is it somewhere you're going to be for 10 plus 15 years, something like that?
Right.
That, again, dramatically affects, in my opinion, how people are looking at these houses right now. Because if somebody's going to be in the property for, they know they're buying their house, and maybe they have kids, or they're buying a place that they can grow into, and they're going to be there for 10 plus years. Quite honestly, if it's your dream house and you love the property, and the price makes sense, and the monthly payment makes sense, and everything like that, I don't necessarily see a reason to pull back from those transactions, especially in our area, in Monmouth County and Northern Ocean County, where there's still a huge, I shouldn't say huge, but I mean, there's still demand for housing. They're not making any more land. So, that's something that people still need to understand, that it's going to be a lot of these situations. There's still going to be bidding wars, and there's still going to be, okay, you don't want the house, someone else will buy it.
Right.
So, at least that's my point of view for the market right now. Now, where we'll be in, I was going to say a week from now, but where we'll be in a couple hours from now, who knows?
Anyone's guess. All right, dude. Thanks for the update. We will do another one at some point, I'm sure. And
Absolutely.
yeah, if anybody's got any questions, you can hit us up, and we'll try to answer them best we can with the info at hand. Talk to you soon, bud.
You got it.
Cheers.